Welcome to this discussion on is Social Security taxed, how it's taxed, and a takeaway for how to strategize your income in a way that is Social Security tax efficient. Before we get into that, my name is Robert Martin. I am the president and a partner here at Zenith Retirement Planning, and I'm also a chartered financial consultant. With that said, let's dive right into it. So how is Social Security taxed? Well, there's a couple things you need to be made aware of first before we dive into this. And the first thing is in your tax environment and retirement, when you start taking your benefits, whether it's early at 62 or later at age 70, you're going to be facing a diminishing Social Security benefit. And I'm not referring to the funding deficit that we're hearing about, how only 75% of benefits will be payable. I'm talking about the tax that will occur that will diminish your Social Security benefit, the Medicare premiums that are taken directly out of your Social Security, thus reducing it. The funny thing is, if all you had on your 1040, if all you had on your tax format, tax filing time was Social Security and no other income, you actually wouldn't pay any tax at all. It's only when income enters, or when you take a paycheck from taxable money past certain limits, does it make your Social Security taxable. And there's two steps to understanding how to compute that, how to calculate that. Now, this will be a general calculation. There are some deeper steps involved that I won't go through with you. But the first idea is you need to calculate your provisional income. And all that is four components added together. It's 50% of your Social Security benefit plus all of your ordinary income, plus any dividends and capital gains, whether they're short-term or long-term, plus non-taxable interest. And so what you're going to get is a number. But let's say, for example, a couple needs $60,000 of income in retirement, and they have $20,000 of Social Security to meet that. And then they have another $40,000 that they can take out of their IRA, and that's the $60,000 they need. Well, in the provisional income formula world, that actually equals $50,000 of provisional income. Only 50 because we take half of the Social Security, which is $10,000, and add that to the 40. So now that we have this provisional income number of $50,000, there's another step. And that step involves applying some thresholds. Now, these are the thresholds for a married couple filing jointly. If you're single and watching this video, then I've included an article below that will show you what those numbers are, as well as outline steps on how to calculate it. But besides the numbers being a little bit different, the concepts are exactly the same. So let's say we went through this, and it involves some steps here that I won't be showing because it took way too many slides to show you how to break this down. But I'm going to apply these thresholds. And basically what it comes out to is based on $20,000 of Social Security and $40,000 of IRA distributions, $11,000 of your Social Security would be taxable. That means $11,000 will come through into whatever tax bracket you're in and be taxable. If you're in a 22% tax bracket, then you're going to be paying 22% on it. Or if you're in a 12%. But let's say instead of taking $40,000 out of your IRA and having a $20,000 Social Security benefit, which gives that couple the $60,000 they need. Let's say we change those numbers, we swap them around. So that's number two. Your Social Security benefit is $40,000 and stands to reason to make $60,000 of income, you only need to take $20,000 from your IRA. These scenarios equal totally different numbers. The first one is the one we already did. $11,000 of your Social Security would be taxable. But on the right, scenario number two, because your Social Security is higher and your other income is lower, your taxable Social Security is a little less than half of what it was before. So with that said, a concept that you might take away is not just that Social Security is taxable and now you know how it's taxable, but it's this concept of the size of your paycheck doesn't matter. Two people could both make $100,000 in retirement, and the way it is made up, its makeup, will dictate what kind of tax you pay. So it's not the size of your paycheck, it's about where it comes from that matters. And with that said, that's a breakdown of Social Security and its tax implications, why it's taxed, things like that. And below, there's also an article I've attached to make things even easier for those of you that like to run your own calculations, for those of you that like to run your own analyses, and I think you'll find that helpful. Before we conclude today, the most important takeaway that I want you to take away from this concept around Social Security taxation is that once you claim Social Security benefits, there's little that you can do to actually decrease the tax on those Social Security benefits. But one of the most important things that you can do is pay attention to your Medicare premiums. Because if you're not paying attention to your taxable income, there's actually tiers where you could make too much money and trigger your Medicare premiums to go up. And those excess Medicare premiums can reduce your Social Security benefits. So I also have another video in the archive about that. Check it out. Now, if you liked the video, give us a thumbs up. And if you think we could improve, please give us a thumbs down. Drop a comment or a question. And please subscribe so that in the future you get access to our content immediately. With that said, take care.